Hello traders, welcome to FreeFX. This is video 131. I am pleased to tell you that I have very little to say about trading today. It's been a very quiet day on the SPX or SPX front, and that's really been the case for other indices as well. So personally, not really much to say about that. In fact, I was tempted not to make a video, but then I thought there's actually quite a bit to discuss there because this video will be preceding the FOMC rate decision on Wednesday. So there's a lot to say, although it's 2 days still to go, but there's not likely to be a lot happening between now and then that could sort of motivate price to go up or down in a significant way. So I thought I'd start the conversation from that, and I was looking around sort of for ideas, and I came up with this, which is how the FOMC rate decision is going to be in a way influential on price, and that's kind of how the video developed. So just to say, first of all, very simple, what is the expectation for the FOMC rate decision on Wednesday? Now, just remembering it's actually a 2-day meeting, Tuesday the 20th. The Wednesday is when they announce their decision, but they meet for 2 days, and that's the Federal Reserve members, the Federal Open Monetary Committee, and Open Market Committee, which is the equivalent of a monetary policy body, essentially. And they the members are voting members and non-voting members, and the voting members are the ones who obviously have the most influence, but also the non-voting members, for their knowledge and expertise, are also an important part. So you have Federal Reserve banks in America, and then the Federal Reserve Bank that sort of puts together members from other Federal Reserve banks and in a way decides on monetary policy for the whole country. The current situation is that we are expecting a 75 basis points or 0.75% rate hike, and you see it there. And that means that it comes down to probabilities for that at 82%. The next probability down is 18% for 100 basis points or 1%. And that is obviously not likely, so it's not expected. So if they were to raise by that amount, it would certainly catch participants' price, by surprise, and price would react more violently, shall we say. It is very hard, since the people often refer to Volcker and the 1970s inflation crisis in the US, and not just in the US, in the UK as well. But the way that those kind of meetings were behind closed doors and smoke-filled rooms and so on and so forth. Now it's very scrutinized. Yes, the meetings are behind closed doors, but there's a lot more media attention on both. The press conferences certainly have exploded in terms of number of press conferences each year, and then you've got the quarterly updates with sort of dot plots and what have you, and then you've got all the media giving interviews Fed speaks are giving interviews to various channels and pundits. So there's certainly no surprise for a 75 basis points rate hike, because it's been highly telegraphed and everybody's expecting it. The 100 basis points, however, that is probably more of a surprise, even though it's there now on the Fed Watch tool. But it will still actually impact. But what's really important, really important, is projections. So people want to see where this is going in the long run. And we certainly want to see the rhetoric, because as I showed you before here, when it comes to December, for example, the expectation is for 25, 50, 75, etc. So essentially there's a consensus that is going to be 25 or 50 basis points is probably the most likely outcome. I mean, these projections are projections, but what I'm trying to say, if you go into February, there are 5 scenarios there, okay? The scenarios really reflect the uncertainties. The more scenarios you have, whereas now we've only really got two scenarios. It's either the anticipated 75 or the 100, you know. So but certainly this kind of puts into perspective the fact that we have this trajectory of rate hikes. Front loading is what's happening. If they did 100 points now, it's likely they'll probably do less in the next meeting. So in a way, you know, some market participants might see that as good news, in the sense that all the pain is done now to the sort of portfolios, whatever, and then, you know, from the next meeting it's going to be less painful. But I doubt that. I think that certainly the reaction wouldn't just last, you know, 5-20 minutes. It would be more, because there's a lot of premium still in indices. So, but let's cut that through, because I want to just get onto this, which is, so I'm looking at Twitter a lot, and I sort of check lots of commentators and analysts, etc. So as you know, I follow John Kickliter, and he's one of my sort of main go-to places, or people I should say. His channel is great, and this particular chart is showing us the differential between the yield differential between the FOMC, so the Fed, and the ECB. The ECB in light blue, the Fed in dark blue above it, and the red is the differential. So you can see that that differential is actually seen to be shrinking, and because we have slightly more hawkish ECB. Now this obviously is not particularly relevant in terms of the Fed and stock market, but it's relevant in terms of the dollar. So again, the conversation is that the Federal Reserve is not alone. So if you remember, during the Bernanke, Draghi, or Yellen, Draghi, and the Bank of England, Carney days, they were all trying to get the inflation to 2%. It was very kind of feeble inflation. Now it's the complete opposite picture. But at the time, nobody really wanted to raise rates because they were all kind of looking at each other. It's very important in the context that central banks are also seen to be aware of the global picture and other large central banks and how they're moving. So, because then the impact of what they're trying to do, if they're trying to fight inflation, which has global origins, obviously if the Federal Reserve is trying to fight inflation, but other central banks around the world, whose countries are also experiencing high inflation, like in Europe, for example, therefore, you know, if they all move in tandem, roughly speaking, that's more likely to have an impact because it's a globally connected world in the financial system than just one central bank racing ahead and leaving everybody behind, which is sort of what's happened. So if you look again at John Kickliter's chart here, it's another chart that he updates frequently, or regularly anyway, and it's one of the sort of how the central banks are leaning. And you've got the dovish kind of side on the left here, with the Bank of Japan being the sort of the slowest in terms of reacting to inflationary pressures, and they actually are very close to the Bank of China and the SNB, Swiss National Bank. Then the ECB is sort of right in the middle there, and it's just leaning to the hawkish side because it's starting to move to that. It's just, you know, raised rates for the first time very recently, for the first time in decades, and so it's starting to move to that point where it may join the ranks of the ECB, the Fed, the RBNZ, and the BOC, etc., but not at the moment. So that yield differential, as I showed in the previous graph, it will start shrinking, but not yet. So at the moment, the Federal Reserve Bank is still expected to be at 4.2 more or less percent. That's the target. The different figures you hear, that's between say 4 and 4.25 or 4 and 4.5 percent this year. Obviously it's a target because we don't know meeting by meeting how much they raised. There's sort of 3 meetings left. We've got the one day after tomorrow, is the announcement for the rate decision. Then we've got November and December, so it's 3 meetings left. So you know, that's kind of where we're at, and that is a very interesting chart to look at regularly. There's also the chart of the SPX itself, which is here. Now it's very messy because I've added a lot of things. You can see it pulsating here, and this is where we are today. So today it says plus 0.56%. We've obviously finished for the day. 10 o'clock has gone and passed. It's been a very strange day today with the Queen's funeral proceedings, and kind of lots of channels following it. I followed some of it as well. Gave me a lot to think about in terms of what it all means, and sort of history and the future of things. But the London Stock Exchange was closed, so the FTSE 100 obviously did not trade today, and the US wasn't, and so all these are US indices, which are sort of overlapped for your pleasure. Now, another thing I put down in this chart, going back to the discussion on the Federal Reserve Bank, is the Fed Funds Futures, and it's this purple line here. Now, just to make it stand out, I'm just going to change that color and make it bright red, because I think it might make it slightly easier to see. So this is the Fed Funds rate. It starts 2016-17 to go higher, and the peak was in 2019. We'll start 2019, and then a big drop. As you can see, also the indices, the yellow is the Russell 2000, the light blue is the S&P 500, and this one here in purple is the Nasdaq. All three had a bad year in 2018. You remember it was a so-called bear market. So that is obviously a reflection of a number of things, but obviously with the rates being higher again, and we have this correlation, negative correlation between higher rates and worse performance in the stock markets. And then the 2020 pandemic crash, you can see that cutting rates, and then starting again this year with rate hikes, and you see that inverse correlation with the stock market from January there. But what's interesting is that the stock market actually started underperforming in January, and then the Fed funds start sort of going higher later. So in a way, that move had already started, and so we can't call it a leading indicator for sure. But if you look at what the Cleveland Fed says about this, is that it's not a very good indicator, because it sometimes overestimates and sometimes underestimates. So what I've done is I checked the actual, on trading economics here, I checked the actual Fed funds rate, so the central bank interest rate. And so if I stretch this to match the dates, so there's your 2018 there, and this is 2018 here. So you can see that they're not so bad. I mean, they're sort of moving slightly differently, but this is obviously a different time scale, slightly more shrunk, so I need to try and match it. See if I can make it more or less the same. Okay, that's as far as I can shrink it. So if I maybe just move this along, I'll do my best. I mean, I tried this and then I kind of slightly lost it there when I moved things, but 2018 is sitting on top there. 2020, it's slightly wider, but you can see that the shape and the momentum is very similar here. So now also this is quite similar again, so I wouldn't say there's that much difference. Of course, when you go and look at this in finer detail, you might find that's the case. Anyway, so trading economics, very useful website. Lots of things there to consider. If you have any spare time, go and look it up. So back to our chart. These are the indices. If I just hide the Fed funds, in fact, I think I'll just delete it there for a second. And you can see all the different indices. I'll just kind of get this to behave a bit better. That's already. So if I just maybe Excuse me a moment, this is very basic stuff, but okay. So here are the 4 contenders. So in the right corner, S&P 500 here pulsating is in fact what I'll do is I'll make it, it's usually it's candles, but I just changed the color to make it a little bit more a bit easier to see the 4. Okay, so we have the Dow Jones Industrial Average in light blue here. We've got the Russell 2000 in yellow. We've got the Nasdaq in purple, and our green is our friend the S&P 500 or SPX. You can see that obviously they'll be moving fairly closely together. The Dow Jones in light blue has been slower at turning in a way, but it has joined the ranks. Had a big drop there. So you can see that they are moving together, making a nice, if you're looking at some kind of a filter or range, they are moving nicely together. And if I added the Bollinger Bands again, there are the Bollinger Bands, and obviously they don't apply to the other indices, only to the S&P, but you can see that the sort of standard deviation there kind of reflects the moves from various indices, etc. I am going to collectively take these out because they're not really of any use. We just wanted to show you that markets are moving very much together, and this makes it very difficult for people to be stock picking at this point because relative performance makes things very correlated. So correlation between assets, between asset classes, makes things difficult to be sort of surgically separated. If you have an index representing the 500 biggest companies, it's difficult to say, I'm going to pick this stock. It may be doing great, but so that's why you have things like indicators such as advanced decline, see how many stocks are advancing, how many are declining, which I haven't looked at for a while, but not now. Because as you can see today, it's been all about this sort of slow mission creep, trying to creep up, but really not much has been achieved. And if I bring back the VIX as well has been fairly lame. I mean, it's not really achieved much. It was doing great and it's sort of curled up and gone quieter. Everybody, I think, knows that this is just the preamble to the big show, the Powell show, and Powell and his team. So it's not really easy today or tomorrow to get much traction. So that's basically what this amounts to. And with the Bollinger Bands, see, you kind of they widened there and they're sort of shrinking again, to some degree, at least the upper band. So the VIX is doing this, and then we'll take it off again just because I want to see this, and put the candles back on because it's what we want to see. So the candles that we have are 2 days consecutive of long wicks, very small bodies, and the wicks are basically retreating from the low Bollinger Band there. Okay, which is a shame because my targets are just below here at 3779 and 3775. So I'm just waiting to get hit here for my shorts and just be done. One of them is actually sitting there, and it has been sitting there since all the way back to the 17th of July, which was here. And that means I came short here at round about here. Yes. So been waiting for a while and just kind of trying to get this over and done with. But very importantly, final thing I was going to mention was my other indicators here. So that's your ATR moving nicely over 70. We're still in a very nice number there, 82.6. So that hasn't declined. Obviously quiet, but hasn't declined. And then we have the other indicator, which is let's find it first. The CCI, my friend, the CCI. And the CCI has been obviously, you know, as I mentioned the other day, bounced off the 0 level all the way down nicely, and we're here just under the minus 100. It's minus 107 at the moment. Okay, so halfway between the 0 and the 200 negative. For the divergence there, which I explained many times before, that's our divergence here from the 6th or 7th to the 13th of September, so 6 days. Then we had the price and CCI together falling. And now for the 4 hour, just because of today really, we've climbed back up to the 0. But I suspect it might be one repeat of early September when we had 2 bounces off the 0, price continuing lower, although it didn't continue lower by much. So actually we are roughly at the same level now that we were here at the start of September. So we haven't really moved that much. Indeed, if I just came out of Bollinger Bands and brought you a view of the monthly, and you can see that we had this 4100 cap there, and we've had the June and July, which are basically sort of wasted months because they cancelled each other out pretty much, June and July. August, as I mentioned, was halfway through retreating or sort of retracing that candle from the previous month, and then this month we had the long wick up and we're trying to move lower. We have a few days left to the end of September, so it's not the end of the month, and we know that September and sometimes October are bad, quote-unquote bad months for the S&P, but they're good months if you're shorting, obviously. So I'm very much hoping this will continue lower. And if we put the Bollinger Bands back on, you see that we are definitely below the basis. And this month, May, was a terrible month because we had the upper wick and the lower wick converging right in the middle there on the basis. So complete mean reversion and indecision. And then we moved south. We've been south of the basis there now for 4 months. And we really have the potential to move lower and to expand this. And this happened all the way back in 2008, the GFC, Great Financial Crisis. We had that before. So you can see that that happened, and we came to, you know, a stall. So that was a stall. Okay. We came to a stall and then started pushing lower, and that was a big drop there. October was a big drop. So September and October. I did this comparison just on the last video on Friday between the 2008 movement through the year, and the idea came from Michael Kramer on Twitter. So he's got the 2 charts kind of overlaid. I just sort of did a similar thing, but really analyzed what happens next, and that's the big drop that we haven't had yet, where you've got the ATR absolutely bombing it up to, you know, the 100. And the VIX also going up to like 80 or something. So that hasn't happened yet. So until then, we've got this sort of scenario of just waiting in this area. And just to say that the level at lower kind of Bollinger Band is about 3650, more or less. So to get to, I mentioned 3430 on the options heat map just the other day, and that was 3430 would take you down this area here. Okay, so below the lower band, and that's quite a drop in itself. As you can see on the CCI, we've still got a way to go here. Yeah, so the ATR is steadily climbing. So I think all these things considered, we definitely have more room to go, and there's just that lack of momentum that we're sort of ground, you know, the ground is there, but we're grinding slower, and it just needs to gather momentum for the final push. So in the meantime, I want to say thank you for watching my videos again, and I will see you in my next video, which will be on Friday at the end of the week after the FOMC and everything else. So an exciting week. Trade safe, look after your capital, like, share, subscribe my videos. I appreciate it. See you in my next video next week. Take care.